Today we are going to discuss Chapter 8, Flexible Budget. I have selected this question at the end of the chapter. Cell1 Technologies manufactured capacitors for cellular base station and other communication application. The company's July 2024 flexible budget shows output levels of 6,000, 7,500, and 9,500 units. The static budget was based on an expected sale of 7,500 units. So what happened, you know the difference between a static and flexible budget. In a static budget, you have only one scenario, which is 7,500, but in a flexible budget, you have multiple scenarios. So here, instead of using only 7,500, they use 6,000 and 9,500. What if we sold more than 7,500, or for any reason, if we sold less than 7,500, what would it looks like? So they gave us the information here that the sales revenue is $21 per unit, which is we talking about the capacitor. And if we sell 6,000 units, it will be $126,000. If we sell 7,500, it will be $157,500. And if we sell 9,500 units, our revenue would be $199,500. Variable expense, they have provided $10 per unit. For 6,000, 60,000. For 7,500, 75,000. For 9,500 is 95,000. So our contribution margin for 6,000 is 66,000. For 77,500 units, it would be 82,500, and the contribution margin for 9,500 units is 104,500. Fixed expense is going to be the same no matter how many units we're going to. So if we sell only 6,000 units, the operating income would be 11,000. For 7,500, it's 27,500, and for 9,500, it would be 49,500. All right, so we continue. The company sold 9,500 units during July, and its actual operating income was followed. So we did sold the highest, and this is the operating income they have provided us, and I'm going to share with you in a moment. So these are budgeted numbers, and these are actual numbers. So in actuality, what happened? We sold 9,500 units, and our sales revenue is 206,500. Over here, if you look at it, it says that if you sell 9,500, your revenue should be 199,500. So our revenue went up by about $7,000. Variable expense we calculated was 95,000. It turns out to be 100,100. So it went up by about 5,100. And our contribution margin is 106,400. We calculated 104,500. So it's not too far from the number. And fixed expense, instead of 55,000 in actuality, they were 56,000. So our operating income is 50,400 instead of 49,500. So everything went up. So they are asking us to prepare a flexible budget performance report for July. And the second one, what was the effect on Cell1's operating income of selling 2,000 units more than the static budget levels? Because the static budget was 7,500, and you sell 2,000 more. So what is the difference? And the third question is, what is Cell1's static budget variance for operating income? So how much is the budget variance? So we're going to calculate these numbers. So the first thing we're going to do is prepare flexible budget. So how is the flexible budget is going to look like? So the flexible budget, we have to find out how much is the favorable and how much is the unfavorable. So first we're going to put number of units. And the first thing we have to do is we know for the budgeted amount. So we so for we're going to talk about budgeted amount. So the budgeted amount we have per unit was $21. That was the the number of units were budgeted we have is 9,500, and then the actual is 9,500. So budgeted was 70,500, but that was the static budget. Right now we're talking about the flexible budget. In actual, we sold 9,500. The sales revenue we had is $21 per unit, and the variable cost was $10 per unit. So we sold 9,500 units, and in actual results we have the sales revenue of 206,500. This is the number that I am taking from the information that is given to me, and the variable expense is 100,100. That gives us a contribution margin of 106,400, and then we subtract the fixed cost. That gives us the operating income of fixed cost is $56,000, and that gives us 50,400. All right, so these are actual results. So now we have to find out the flexible budget variance. So the next thing we're going to calculate is the flexible budget variance. The flexible budget variance that we're going to calculate is based on the difference between the actual results that we have discussed here. So these are actual results, the difference between the actual result for 9,500 units and the budgeted amount that we have here for 9,500 units. All right, so let's calculate. So how much is the difference between the actual budgeted amount was also 9,500, so there is no difference in number of units, but for the difference between 206,500 and 199,500 is $7,000. Now we know that the variance either is going to be favorable or unfavorable. Okay, so if the revenue is increasing, it will be considered a favorable increase. Very good. The variable expense is 100,100. So our variable expense went up because our budgeted variable expense was 95,000. So how much is the difference? Is $5,100. Now, is this $5,100 favorable, unfavorable? Since the expense is going up, so it will be considered unfavorable. Always remember, if revenue is going up, it's favorable. If revenue is going down, is unfavorable. If expenses are going up, it's unfavorable. If expenses are going down, it's favorable. So the contribution margin is 106,400. We have budgeted 104,500. So the difference here is 1,900, and that 1,900 is favorable. So every time contribution margin goes up, it's favorable, and it goes down, when it goes up, it's favorable. When it goes down, it's unfavorable. The next thing is fixed cost. The fixed cost we have is 55,000. So our fixed cost is going up. So obviously it is going to be unfavorable. Overall, our operating income was 50,400, and we said that it should be 49,000 900. So it went up by 900. So it will be considered favorable. Okay. And so the flexible budget that we have created for it's right over here, because this is the flexible budget given for 9,500. In actuality, we sold 9,500 units. So therefore, we don't have to make any changes, and we're going to write down the whole thing as is without making any changes. So the revenue was 199,500. Our variable cost was 95,000. So our contribution margin is 104,500, and our fixed cost was 55,000. So it's 49,500. I am not calculating anything. This is just a given in the data. I just write it down, this thing. Now we have to calculate the sales volume variance. So the sales volume variance I'm going to write this thing down over here for you. Sales volume variance is equal to flexible budget minus a static budget. Okay, so what was the static budget for 7,500? All right, so the 7,500, the static budget was it would be 157,500 our revenue. Our variable expense was going to be 75,000. Our contribution margin is 82,500, and our fixed cost was 55,000. So our operating income is going to be 27,500. Now you must be thinking, how did we calculate this 157,000? So remember, in the static budget, our number of units were sold were 7,500. So we're going to take these 7,500 units, multiply by $21. So when we multiply this by $21, 7,500 multiplied by 21, it gives us 157,500. That's how I got this number over here as 157,500. This was for sales revenue. Now let's calculate for variable cost. 7,500 units multiplied by $10 is $75,000. So that's how we calculate the $75,000 over here. Now the sales volume, so this is our static budget. So we calculate the difference between the static budget and flexible budget, which is flexible sales volume variance, which is flexible budget minus the static budget. So the difference between 199,500 and 157,500 is 42,000. And 95,000 and 75,000 is 20,000. And 104,500 and 82,500 is 22,000. And there is none, because 50,000 minus 50,000 is 0. And 49,500 to 27,500 is 22,000. Now, which number is favorable? Which number is unfavorable? You notice your flexible budget is greater than your static budget, therefore it is favorable. You notice that your static budget was 75,000, but your flexible was more, so this will be unfavorable. Your flexible budget was 82,500 and this one is 104. So this is your contribution margin. Just like sales is going up, contribution is margin is going up, therefore this will be favorable as well. But since the variable cost is an expense and it is going up, it is going to be unfavorable. And your static budget operating income was 27,500, but your flexible budget operating income is 49,500. So you have a 22,000 increase in operating income, therefore it is going to be favorable. Now, you notice that in a flexible budget variance, we have to calculate that. Flexible budget performance report for July. We have already did that. So the next thing we have to calculate is the flexible budget variance. And the sales volume variance. So how we calculate this one? So the flexible budget variance, as you see, is $900. This one, $900, and it's favorable. And your static sales volumes is $22,000 favorable. So this number is coming from here, and this number is coming from here. So this is the two numbers. So these are the two numbers. So what is the static budget variance? So if you take these two numbers and find the static budget variance, that would be 900 favorable and 22,000 variable favorable. Therefore, it would be the number would be 22,900 favorable. This is our static budget variance from these two numbers. Because both are favorable, so we're going to add these two numbers. What if this one is unfavorable and this one favorable? You just subtract this one from here. What if this one is unfavorable? So that will be, it's a bigger number that will become automatically unfavorable here. Okay. Now we're gonna go and look for 2,000 more units. So according to this question, our static budget was for 7,500 units, sorry. And our flexible budget has three scenarios: 6,000, 7,500, and 9,500. And we compare these. So we can say that, so we have sold, so requirement number 2, to answer requirement number 2, what was the effect on sales 1 operating income of selling 2,000 units more than the static budget? So what happened here when we sold 2,000 more units? So by selling 2,000, so this is number 2, 2,000 more units, the static budget has increased because it has more sales. So right now we calculate 7,500 units multiplied by 21, so it has 157,500. If we sell only 9,500 more, so that's why it's increased the budget. And operating income increased, and operating income increased by $22,000. The favorable over here. That's the sales volume variance. Means if your sales volume has increased, which has increased by 2,000, so that's why you have a $22,000. Okay, and the requirement number 3 is what it sells one is static budget for operating income. So how much is the difference between the operating income? So the number 3 is what it sells one static budget variance for operating income is $22,900. So static budget variance is 22,900 and it's favorable. Is F only stands for telling you favorable, that is a positive number, it's an increased. If you have any question, please let me know via email. I would be love to hear your comments on this video. Thank you.